Assalamualikum OyaRahmatullahe OyaBarakatuhu. Welcome to my virtual classroom, MKA Classroom. Now let's start today's video tutorial. So now we will start financial statements and ratio analysis. So we will see at first stockholders report. Then every corporation has many and varied uses of the standardized records and reports of its financial activities. Periodically, reports must be prepared for regulators, creditors, lenders, owners, and management. The guidelines used to prepare and maintain financial records and reports, known as generally accounting principles (GAAP). That means these are the practice and procedure guidelines used to prepare and maintain financial records and reports authorized by the Financial Accounting Standard (FASB). Now, what is FASB? FASB, the accounting profession's rule-setting body, which authorizes generally accepted accounting principles. They are the actual body which try to prepare these accounting rules and regulations. So then letter of stockholders. The letter of stockholders is a primary communication from management. It describes the events that are considered to have had the greatest effect of the firm during the year. It also typically discusses management philosophy, corporate governance issues, strategies, actions, as well as plans for the coming year. Stockholders report, that is the annual report that publicly owned corporation must provide to stockholders. It summarizes and documents the firm's financial activities during the past year. Then here we will see letter of stockholders. Typically the first element of annual stockholders report and the primary communication from management, that is the letter of stockholders. That is a management of communication skills to communicate with the stockholders and the management of the firm. Actually there are the 4 key financial statements we have. One is income statement, balance sheet, statement of stockholders equity, and a statement of cash flows. These will be discussed in here. Income statement. The income statement provides a financial summary of the firm's operating results during a specified period. Most common are income statements covering a year period ending at a specific dates, ordinarily December 31st of calendar year. That's the income statements. There is a financial summary of firm's operating results. It should be noted that firm's operating results, that's related to the income statement. So here has actually pro forma of income statement: sales revenue less cost of goods sold, then we can get gross profit. From the gross profit, if we less the operating expenses, the selling expenses, general and administrative expenses, lease expenses, depreciation expenses, then we can get the total operating expenses. And if we deduct this total operating expenses from gross profit, then we are getting operating profit. Operating profit has the another name is EBIT, earning before interest and tax. From this EBIT, if we deduct interest expenses, then we can get net profit before taxes. That means EBT, earning before tax. After that we will deduct taxes, then we can get net profit after tax. Net profit after tax, NAPT, net profit after tax. And if this firm has the preferred dividend, preferred stock, then you have to now deduct this preferred dividend from your net profit after taxes. Then the result is in here: earning available for common stockholders. These are the actually earnings available for common stockholders. If you know these earnings can be divided by number of outstanding share, then we can get EPS, earning per share. So earnings available for common stockholders divided by number of outstanding shares, then we can get EPS, earning per share. So these are actually the formula. And DPS can be calculated in this way: calculated dividing by the dollar amount of dividends paid to the common stockholders by the number of shares. That means the amount which are tried to provide to the common stockholders, decision taken by the management of the firm, then we divide by it the number of outstanding share, then we can get dividend per share. Dividend per share. So here has several value. This value can be seen in the next whenever we are talking about our balance sheet. So dividend per share: dollar amount of cash distributed during the period on behalf of each outstanding shares of common stocks. So balance sheet, here is the balance sheet. Summary of a statement of the firm's financial position at a given point in time. Summary statement of firm's financial position at a given point in time. That's the balance sheet. So summary statement, and here has the current asset, current liabilities. So in the balance sheet there has current assets, current liabilities, long-term asset, long-term liabilities. An important discussion is made between short-term and long-term assets and liabilities. The current assets and current liabilities are short-term assets and liabilities. This means that they are expected to be converted into cash or paid current liabilities within 1 year or less. That means Current assets or current liabilities which actually mature within 1 year or so, and all other assets and liabilities along with the stockholders equity which is assumed to have an infinite life are considered long term or fixed because they are expected to remain on the firm's books more than 1 year. That's the current assets and long-term assets, long-term liabilities. The assets are listed from the most liquid cash down to the least liquid marketable securities are very liquid short-term investment such as US treasurables or certificate of deposit held by the firm. Because they are highly liquid, marketable securities are viewed as a form of cash, so it should be near cash. Accounts receivable represents the total monies owed firm by the customers when the credit sells. Inventories include raw materials, work in process, partially finished goods and finished goods held by the firm. The entry for gross fixed asset in the original cost of all fixed assets owned by the firm. So here is the long-term debt for which payment is not due in current year, paid in capital in excess at par. So here is the long-term debt, long-term assets matter. So here we are going to see a pro forma of balance sheet. Assets, in assets, cash, marketable securities, accounts receivable, inventories. These are the current assets. These are the total current assets. Land, buildings, machinery, equipment, furniture, fixtures, vehicles and others, it is treated as a long-term assets. So from this we have to deduct the accumulated depreciation, the next fixed asset and total assets. Then liabilities and stockholders equity. Accounts payable, notes payables, accruals, these are the total current liabilities. Long-term debt, there is a long-term debt. Preferred stock, common stock, there is a here is a said there is a preferred stock. It has preferred stock, cumulative 5%, that means dividend 5%, 2000 shares authorized. Common stock 2.5 per share value of the common stock, and outstanding shares in 2012 it is 76,262. Issuing share 1 lakh shares authorized, but outstanding in the market is 76,262. There is the outstanding share. Then that here we have said that how we can calculate EPS. So this is our earnings available to shareholders. These are the earnings available to shareholders. Here is the amount and divided by our number of outstanding shares in 2012. In this way we can calculate EPS, earning per share. So then paid in capital in excess for the common stock, retained earnings, total stockholders equity and total liability and stockholders equity, and these are the total assets. So assets equal to liabilities. So these actually are the form of balance sheet, retained earnings, which we save for our company's expansion. Actually, we are saving for the company's expansion. Then we will see a statement of retained earnings, reconcile of net income earned during a given year and any cash dividends paid with the change in retained earnings between the start and the end of the year. The abbreviate from the statement of stockholders equity, that is a statement of retained earnings, which a portion should be written for the company's expansions. A statement of cash flows, so provide a summary of firms operating in investment and financing cash flows and reconcile them with the changes in cash and marketable securities during the period, that is the cash flow statement. These are the four types of financial statements which we are already discussed. Now we will see ratio analysis. So ratio analysis actually involves the methods of calculating and interpreting financial ratios to analyze and monitor the firm's performance. There is a ratio analysis. It involves the method of calculating and interpreting financial ratios to analyze and monitor for the financial performance. So here we will see several types of ratios which we will use to calculate. Here several cautions, you can see it. Our discussions is related to the categories of financial ratios. So financial ratios can be divided for the convenience into 5 basic categories. One is liquidity, activity, debt, profitability, and market ratios. So liquidity ratios, activity ratios, debt ratios, profitability ratios, and market ratios. These are the basically 5 types of ratios. This all about today. Stay home, stay safe. Assalamualaikum warahmatullahi wabarakatuhu.